Hello, friends. Today we'll be taking up another topic, which is international banking challenges. One of the major concern with international banking is like many a times you must have seen that when banks do have their international exposure, and you see some sort of global phenomena which is negative in nature, like some sort of global phenomena of recession or depression, then sometimes these international banks who are having exposure to many foreign countries may not be able to recover their uh, like loans from these overseas partners, and hence may go into bankruptcy. Now you see, in this today's presentation we will try to see some of the challenges which are connected to international banking. Okay, so the global banking industry has lots of complex issues. So many a times you will find that trouble is because of cross border operations. Countries do vary in terms of their laws. Next is like cyber threat is very common because you're operating in not only one country but in many countries. So you do have data uh, secrecy and like you see protection uh, prerequisites. So it is sometimes a very big challenge for a player who is international in nature. Now we'll try to understand some of the reasons for bank failure and how it affects various stakeholders, uh, bringing in dynamism into this particular landscape. Okay, let's go in further. Now you see, the main reasons for any bank's failure is excessive risk taking. Let me explain it in a with the help of an example. Imagine there are two banks. One bank is very defensive, yani they don't give loans easy. They have a very stringent procedure. On the other side, there is another bank who is a bit aggressive, and they would like to give it to everyone. Let's say students are given credit cards is an example, good example of it. Now students with no source of income, and you see they are given credit cards. What they'll do, they'll consume it, and when it comes to repayment of these loans, maybe they will not be in a position to repay it back. So institutions who are a bit aggressive in nature and they're very comfortable taking risk, you see, this is not your money, this is public money which you are giving it to another set of clients from your same market. Sometimes when you go a bit aggressive and you lend it to some of your subprime clients, then this is going to happen. Any these bank failures will be ultimately, you see, this is what is expected when you have certain practices in place which are vulnerable in nature. Okay, so this will bring in collapse for your banking system if you try to get bit more aggressive. Now hence what happens is like regulators, banking sector, apex authorities, central banks will be putting in some policies in place so as to have limit the exposure of different players. Okay, so because you have to take license from central banks, hence you will not be going beyond a particular limit. You have to give your documentation, transparency has to be maintained. So excessive lending concentration is not allowed. So diversification and periodic reporting of your portfolios will make it bit safe and secure for your clients and other stakeholders. Let's go forward. The next point where banks may go down is, you see, fraudulent practices. Imagine a bank without proper audit. You see, unethical and fraudulent practices are very common. Yani, let's say, I remember the case of Citibank in which approximately 300 crore rupee was embezzled by one of their staff. Now, you see, senior staff member who are regularly in touch with clients are into a position where they may misuse their fiduciary power, the position which they have got from their institution. So, manipulation or embezzlement of funds or money laundering or misrepresenting asset class to your client base, giving them false promise or some sort of mis-selling, will all leads to fraudulent practices and may bring your bank down. So collapse is all possible. Huh? Initially, maybe people will not be able to figure it out, but sooner or means shortly, very shortly, people will understand the modus operandi. And you see, once this problem is going to initiate, it will be having very serious repercussions for the institution. Next is like poor management. Any top management who is into the decision making role, their leadership is not effective. Maybe they are making some policies which are inadequate to cover up for risky provisions. Now you see, this is where banks inability at the top will have an effect on banks performance and long term sustainability. Means market may look attractive, But now point is like because of their policy, what they have done is like they have speed up like anything, and you see they have taken a major chunk of your market. So when you do something like this and bit aggression, or maybe bit defensive, means everyone is lending, but you are not interested to lend. So any of these two extremes may take you down. So it is basically poor management, poor policies at the top, which will not be able to generate the desired results, can lead to a big disaster. Okay. Next is loss of confidence. Now imagine being a bank, central bank of your country, like in India, it is Reserve Bank of India, puts up a notice in media, social media or print media that doing any sort of transaction with ABC Bank is under considerable amount of risk. So please do not do any transaction with ABC Bank. Imagine if this type of notice is coming against your bank, what type of message is going into public at large? The regulator is restricting them from going into any transaction with you. Why? Because regulator is fearing that there may be a run on a bank. So bank run is mentioned here in the point number 4. What it means ki like maybe due to lack of confidence, people may start withdrawing funds, and maybe bank is not in a position to repay them all in one go because money has been used for giving loans, and loan parties will pay you after 5 years, 10 years down the line. So it happened with Bank of Punjab. Now you don't have Bank of Punjab. It got merged with Centurion Bank, and then later on HDFC took it over. Now point is like when it was there, there was a situation where some of the branches they faced very harsh situation. Any maybe I don't know how it started, but there was a rumor that this bank don't have liquidity in it. So you see what happened is like customers starting spreading this message to everyone in neighborhood, in society, and what happened is like ultimately everyone started withdrawing their funds, and bank was not in a position to pay them all, and hence again this message is getting confirmed that yes, bank is not in a good position and will be able to pay you back. So they were asking their clients to hold back for some time. So this is a situation which is regulator don't wants to happen. It may take you to a total collapse, even though you are a sound agency, sound institution, but this type of rumor may take you down. Now you see some of the indicators which tells you that yes, bank is actually not good in shape and may go down is deterioration of asset quality. Means just imagine the quality of your asset is going down. Instead of going up, it is going down. What it means, like if you look into Narsimhan committee recommendation, you'll find that asset is classified into multiple classes: standard, substandard, doubtful, and loss. So these are the 4 classes. Imagine when you give the loan is into standard category, but after 6 months or 1 year down the line, now the counterparty, the borrower is not repaying you on time, and hence this loan has gone into NPA. Now you see NPA means non-performing asset is not good for bank. So you see, it is actually eroding your quality of your asset. So it will put additional pressure on your bank to have provisioning requirements fulfilled for this type of asset. So one is you have competition due to which profits are not happening. On second side, you are getting your quality of your asset going down, which leads to additional pressure on your resources. So it is going to take your bank down for sure, not in short run, but in long run. Next is declining profitability. Imagine, you see earlier when we started banking, there were only few players. Then the number of players started going up, and then you see look into Indian market condition. You find public sector bank followed by private sector bank, old generation, new generation. Then you found foreign banks, cooperative banks, regional rural banks. Now you see they all are there. Now you have a new set of competitors. Who are they? Payment banks, small finance banks. Okay, and then you have a new set of altogether new set of competitors. Peer to peer lending. Peer-to-peer lending means you need not to go to any bank. Instead, you can directly approach a depositor or a borrower, and then you are saving your bank margin also. So you see, these all factors are affecting your profitability a lot. So many payment apps have taken over your remittance business like anything. Payment app, I'm saying. Paytm, phone pay. Have you ever imagined earlier who was doing it? All these transactions, fund transfer from one bank to another bank. It was all done by banks, but now it is taken over by other financial intermediaries. Okay, so this is what is bringing in pressure on profitability, and it is very clear if you're not able to maintain your margins, you have to go down. Now you see, regulatory oversight and risk management practices is what can save you from this disaster. But imagine RBI or your central bank is only one How many like supervisors can you put in your market? You may have hundreds and hundreds of players. Checking them all will require a very big audit team, on site, off site. So many things are required. So you mainly depend on this element of trust, and this element of, like, you see, mutual trust, and like timely submissions, transparency. Now what you do is, like, sometimes when institutions do it intentionally, it's very tough to catch them. They're doing it knowingly. They're window dressing. So you see, it is going to take time, and if most of your players are into the same practice, so it is very tough for your regulator. Let's go back to your regulatory framework. It needs to be robust. Now, when I'm speaking on regulatory framework, I'm speaking about Basel Committee on Banking Supervision. Now, you see, these are global standards which are set by BCBS committee, and it is supposed to be implemented by central banks or apex authorities in every country. Now, you see, let's say we do have a bank called as State Bank of India in India. So they are supposed to this risk management uh, practices. They have to implement these risk management practices. Till date, Basel 1, 2, 3 guidelines have been implemented. Banking system has adopted it well. Now Basel 4 is in process. So the moment it is ready, we have to bring in Basel 4 also. Now you see, every time we are bringing in a new set of rules and regulations, it is a bit tough for existing players to adapt to them. But you see, if you don't do it, then you are, what it means, you are not fit, and you should be thrown off the market. So if you cannot survive the pressure, then you have to take an exit. There is no other way. So you have to take the challenge like this. Okay, so there is no other way. uh, and then proactive monitoring is, banks are supposed to be monitored by a regulatory agency. Okay, regulators need to watch it regularly. So artificial intelligence, financial technologies, data mining. So this is all what is required, need of art. You cannot do it manually. You have to use artificial intelligence for sure. You see, with the induction of artificial intelligence and technology interfaces, uh, you see, regulatory technology interface is going to make sure that banks are error free. They should have regular testing. They should have regular audits. They should have periodic, like, fulfillment of all the compliances that are must. And you see, if something goes wrong, you see, a regulator will ensure adequate provisioning and support for institutions which are failing or which are into a bad shape. Now, stress testing is a very good phenomena which European banks have started it. Now, you see, after subprime crisis and then European crisis, we had this concept of stress testing. So, stress testing is a situation where you test your institution's sustainability in a tough market situation. Let's say profit margins going down, interest rate having a negative impact. Now, here, how it is going to affect your balance sheet, how it is going to affect your cash flows, is what you study in stress testing. Yeah, it is very shocking to know that in initial stages of stress testing, most of the banks which were evaluated, they all failed badly. What it indicates? Market is vulnerable. Market or industry, this banking industry is very, very vulnerable. So you need to strengthen it up with more of buffers, more of policies, measure which brings in safety and security for all stakeholders. Next is risk mitigation strategy or risk management strategies. Now what we need to do is, like, we need to go for, like, credit risk, market risk, and operational risk modeling. So you plan for it in advance, and according to the possible outcomes, you see, what you need to do is, like, you need to mitigate it to some counterparties. Mitigation is transferring the risk to other parties. There is always a mitigation cost. If mitigation cost is less than your actual loss, go for it. If mitigation cost is more than your actual loss, then try to absorb the loss of your own. So mitigation is very important. Okay, so if you are able to mitigate all your risk, because you cannot avoid them, then you are into a good shape. So it involves a cost is to be borne from your profits. So banks, if they have sufficient amount of profit, they can manage this risk also. Okay, so let's go forward. Now, impact of bank failure on customer. What will happen if a bank goes down? So you see, imagine people have very, they have their trusts on banking system. So imagine if any day you wake up and you find that State Bank of India, India's biggest bank, HDFC and ICICI, all three of them, they go into bankruptcy. What will be the effect of this on the market? Imagine. It will bring in a disruption. It will bring in hardship. People who have saved throughout their life with lots of hardship will be totally blank, because now their bank is no more available for their support. You see, we no doubt we do have deposit insurance, which is up to 5 lakh rupee per account. But you see, this may not be sufficient for every type of account, because some accounts do have more than 5 lakh rupees. So the maximum coverage is only 5 lakhs. So you see, point is, if a bank is going to fail, it is going to affect your trust like anything. And once public trust is lost, you see, there is no way out. There is no reversal to it. It may take a decade or more than that to bring that confidence back. Hence, you see, Ministry of Finance, Reserve Bank of India, and all other regulators at the top, they ensures it that no bank should go down into problem. So they do have a concept of moratorium. So if something looks suspicious and banks are not able to meet the requirements, the set standard requirements, then you see banks are supposed to undergo a concept called as moratorium, whereby they are not allowed to either accept deposit or to lend new loans. Okay, so this freeze can be maximum for a tenure of 6 months. Now, what needs to be done is, like, Reserve Bank of India will approach a court and will get this moratorium orders for a bank, depending on their poor performance or poor financial situation. Okay, let's go forward. Now, impact of this failure on employees. Just imagine you are not able to get your salary for months and months. Why? Because your bank is locked. Your bank has not been able to do anything. Restructuring is on the way, but it is taking time. So once you leave this institution and you try to give an interview for some other institution, what you know what will happen? Negative branding will also move along with you. So maybe it is very tough for an institution or an employee of an institution which failed badly to get an alternative job. So it's very tough. It's going to be very tight job market. Okay, so it may have some sort of blacklisting also, because how this bank went down, it may be top management policy, it may be the defective working of staff members, so it can be anything. So hence there is a problem. Okay, so you need to be emotionally stable during this time. It is going to be very high voltage problem going to be there. Like, once you don't get your salary, how are you going to run your families? How are you going to maintain your families monthly expense? So it is going to be very, very tough. Okay, let's go for the next segment, where it is shareholders. How a bank failure may impact a shareholder. You see, shareholders do get their return from their investments from share market. If a bank is going to fail, how it is going to react in market? Can you see the image here? It is a chart where there is a reversal trend in red color. So when it is going up is good, but when it starts falling down is not good. And you see, you may get a zero or something negative return. So where your entire investment amount may be wiped out, even though this bank is going to be merged with some other entity, but because they have a very bad shape here, so maybe it is nothing for investors. So investors may lose out everything. Okay, now this is for retail investor who is doing direct investment. Imagine for pension fund, for insurance companies, for mutual funds who are bulk investors. They also must have some exposure to these defective institutions. So if this company is going down, then you see a big chunk of your society is getting hit through these pension funds and other financial intermediaries. Okay, their implications are going to be very high. So per unit or net asset value may go down because of the non-performance of some of the banks. It will bring in ripple effect. One bank going down will create panic in the mind of customers and may bring in multiple banks going down simultaneously. And it will be very tough for your regulator to bring in stability in that situation. Okay, if a cooperative bank is failing, RBI is facing lots of problems. Imagine if big banks are going to fail. There is no, like, you see, there is no solution to that problem, and it's going to be very, very tough. Unimaginable pain will be there in your market. Impact of bank failure on local economies or national economies. You see, loss of jobs, loss of livelihood, lack of trust, damaged infrastructure. Means now you don't have jobs, you don't have banks who are functional, hence buildings will be vacated. So tax collection from these banks will not be coming in. So you see, it's a negative impact on your economy. And then broader financial instability will be coming in. Now you see, few banks failing is an indication that there is a flaws in system. Maybe you see, in coming days there are many other banks are going to fail. This type of perception will bring in negativity, further negativity, and it will trigger the vicious cycle of poverty. Okay, so it will be a very, very negative scenario where no investments, no further promotion, no production, no consumption, and you see, this is going to be very adverse. Now, strategies for preventing or mitigating bank failure. One is your regulatory framework needs to be robust. AI and all needs to be used. You see, we can check manually, we have a limit, but when it is AI, you can check it 24 into 7. Any sort of error that you find from any of your online documents, you can track it very easily, and you can simply have a, like you see, remedial action for the same. Prudent risk management practices. You see, right, the Bank for International Settlement (BIS), Banking Committee for Bank Basel Committee for Banking Supervision. You see, these are going to create rules, regulations, and policy framework for risk management. Now you see, they are global agencies. So when they create something, is going to be handy for everyone. So follow them without any doubt. But you see, implementing a new policy may take some time, may require some sort of advanced training for the staff members and people who are dealing with it. Now you see, it actually will be a time consuming process, and resource engagement must be there. Next is like a diversified asset portfolio. So here they are emphasizing on diversification and not on concentration. Don't give loan to one single sector, don't give a loan to one geographical area only. You need to diversify. When you diversify, your concentration risk goes down. Effective crisis response team. So you should have a disaster response team ready to take care for any sort of situation that is going to come. So you see, proactive contingency planning should be there, so as to avoid any failure on a larger scale. Okay, so you see, small cases may be identified and can be taken care of at a very initial stage. So don't allow them to grow in size so that it will be a big failure and later on government may not be able to manage it. So if you get any warning signals, so take initiative. Whistleblower can also be a part when top management is not discussing it with the RBI. So any of your staff member can also go for whistleblowing practice and inform it to RBI. The conclusion is like it is very important to have a proactive risk management system in international banking. Why? Because when banks are taking exposure globally, so it's very tough to deal with it, because tracking different countries is very tough. And you see, imagine overnight you have a co-op in a country. Like I'll give you some examples. Afghanistan, you saw Taliban taking over. In Burma, you saw military regime taking over. Similarly, you see many countries, there is lots of issues going on. In Pakistan, Baluchistan area, civil authorities fighting with your defense establishment. Means what is this? This is all indicating that law and order issues are there. And if law and order is going to be a problem, or like you see, if your political establishment is going to be overruled by another set of agencies overnight, means it is going to be a big trouble. And maybe banks may fail badly. But why? Because you see, new regime don't have any agreement. Okay, so there will not be any repayments there. Thank you. Take care. Good day.